Hey everyone, welcome back to my channel. If you've been watching a lot of my recent videos, I have been talking extensively about the relationship between the producer price index and the consumer price index. So this chart right here shows you the producer price index in blue and the consumer price index in red. And it shows the year-over-year change, and you can see how high producer prices have spiked in the last year. They've spiked over 19%, and now they're pushing 20%. And if you've listened to my videos in the past, and I'll post a link to at least one of them so that way you can watch that, there tends to be about a 3-to-1 relationship between the spike in producer prices and the spike in consumer prices. So right now, producer prices being at 19.8% year over year are really showing that the consumer price index should be pushing over 6% and probably about 6.6%, somewhere around there, to reflect the ratio between consumer prices and producer prices as they have historically done. So you can see here the spike of producer prices here in 2008. It's roughly been about, a 3-to-1 relationship. You can see the spike in producer prices here has been about a roughly 3-to-1 relationship, and so on and so forth. But one of the interesting mysteries that I had a hard time figuring out was that in times past, that didn't used to be the case, okay? So in times past, the producer price index and the consumer price index had different variance levels. So back in the early 1910s, 1920s, it almost had a 3-to-1 relationship when they spiked here, but then there were other times when that clearly was not the case. And you can go and look through all throughout time how that relationship kind of changed. And I was always puzzled about that, particularly that in the last 40 years or so, we could see high spikes in producer prices, but yet not see those corresponding spikes in consumer prices, or at least not to that level. Because in large part, it looked like the producer price index and the consumer price index would track fairly well with each other, okay? They would track pretty closely. Now, clearly you could see that producer prices would spike when there was high inflation, but then they would come back down and kind of self-regulate. So that the overall chart between producer prices and consumer prices looked more like this. And they tracked very well, very close to each other, okay? They tracked very close to each other all throughout time. Now, that being said, let me go ahead and adjust here logarithmically on the scale so that way we can get more of an apples to apples comparison here. So producer prices here are in red. The consumer prices here are in blue. And you can see that there have been times when producer prices have been elevated for some time above consumer prices, but they still would in large part track well with each other, okay? That is until the mid-1980s, and then something happened, okay? Something happened here that caused almost a permanent divergence between producer prices and consumer prices, where the producer price index would languish behind the consumer price index in terms of rising prices. Now, it's been a narrative, and I think it's been a justifiable narrative, that inflation numbers that we measure using the consumer price index kind of understates inflation. So we're saying that the consumer price index is too low on the inflation scale. It's not capturing that full inflationary effect that has been going on with government policies and Federal Reserve policies. Yet when we look at the producer price index, it's even lower than the consumer price index, and it has stayed low for the last 35 years. Yet before 1980, producer prices tended to, as an index, for the most part throughout time, since we started tracking them in the mid-1910s, those producer prices used to substantially be higher than the consumer prices. And it sort of makes sense, because when you have initial monetary policies, especially expanding through debt markets, it first bids up the price of commodities, which is what the producer price index tries to capture. Then it filters down to consumer prices, okay? But in essence here, for the last 35 years, we've seen a reversal of this. And for a long time, I was puzzled by this, which is why I hadn't produced a video of this earlier in the last month. And it was just until a couple of days ago that I kind of solved the riddle here. And the riddle that is keeping these producer prices low is oil. So during the 1980s, there was an oil bust, okay? It was the first of a series of oil bust. And they kept oil prices low. And oil prices remained low until the 2000s. During the 2000s, oil started to rise in price globally. They started to escalate. And if you noticed here, the producer price index became eerily close to the consumer price index again. So we were facing expensive oil, and so that was pushing up the price of all commodities. Then during the mid-2010s, we had a bust in oil, okay? And that was caused by the shale boom. So shale made oil cheaper, which then dropped the price of all commodities until just recently when we've been seeing oil rebound from all-time lows, pushing up commodity prices. Now, why would low oil prices lower the price of all other commodities? Well, in my opinion, it's because every business uses oil for energy, okay? So it is part of the cost structure of every business today. Therefore, the price of oil, the cost of energy, is embedded into the cost of producing every single good today. All right, so why didn't it lower the consumer price index? Well, I think it held the consumer price index lower, but because the CPI's weighting of energy prices is only a measure of 6% of the CPI, I'm willing to bet that oil takes up a larger share, energy costs take up a larger share of the producer price index of commodities than it does take up the 6% share of the consumer price index. And I think that's what's causing the discrepancy here, okay? Something else to note is that I think that the low producer prices that we've been seeing for the last 35 years has kept the cost of capital relatively low in the United States, which has helped constrain the consumer price index from reaching and growing at higher rates of inflation, okay? And I think that can be measured here. So when we look back at the 1980s, we see how the consumer price index inflation measured here in red, the year-over-year rates were dropping from about 12% in the 1970s. They averaged about 7.5% overall. Then they peaked at 15% in 1980. Look how they dropped in the mid-80s. Look how that consumer price inflation dropped. And that coincided with a plunge in producer prices. Yet I don't think that the plunge in producer prices was really caused by deflationary monetary policies all the way. I do think that Paul Volcker's relatively deflationary monetary policy had a part to play, but it was really that plunge in oil prices, this glut in oil, that really started driving this PPI really low, okay? And as a matter of fact, it drove those rates so low that they kept the consumer price inflation from reaching high levels. But here we see that the producer prices started to spike here. And what I've done is created a calculation and put the percentage of producer prices as a percentage of the consumer price index. So you can see that the producer price index went as low as 75% of the CPI. Then it started to spike in 2008. In 2008, it reached over 90% of the CPI. And now it's beginning to spike again at about 85% of the CPI, which is the highest that it has been since the early 2010s when we were faced with high oil prices before fracking and the shale oil boom kind of dropped those prices. So then what's the lesson to be learned here? Well, what were to happen if high oil prices started to converge the producer price index and the consumer price index once again to a historical norm where the two lines start tracking each other as they have in the past? Well, in my opinion, what it would do is that it would no longer, the low producer prices, the low cost of capital, would no longer act as a buffer to consumer prices, and instead they would start pushing up the consumer prices at more or less the same rate that the producer prices are being pushed up. So now going back to my chart here, remember how I have been telling you that the ratio of the spike in producer prices to consumer prices has been about 3 to 1. If we were to see a convergence of these two lines of the consumer prices and the producer price index, I don't think this 3-to-1 ratio would hold. I think it would go back to more of a historical norm where we start seeing the producer prices and consumer prices start correlating and running up more or less with each other, especially during the 1970s. Now, granted, we could see where the producer prices would peak, but even if we get a situation where consumer prices are rising at, say, 50% or 60 or 70% of the producer price inflation, that would cause systemic consumer price inflation, and I think that could be alarming to our economy today. So take that for what it's worth and weigh that in your mind. Do I think that we're in trouble yet, that we're reaching that point? No. Why? Well, that's because the producer price inflation is still, the index is only still 85% of the CPI. So it hasn't reached up to these levels that it did in 2008, and it hasn't reached up to the levels yet in the 2010s, but if we continue to see the PPI start pushing up and up and up, then yes, I think that could put pressure on the CPI to start systemically raising prices over time and leading us into a situation of stagflation, much like we saw in the 1970s. Thank you guys for watching this video. If you like my content, make sure you hit that subscribe button, like the video, click that notification bell, and also you are more than welcome to comment. Let me know your thoughts about this, and I'll continue to post videos regularly. I'm not sure when I'll post the next video, but the next one will probably relate to this producer price index, consumer price index situation that we've had going on, because that seems to be the prevalent issue in our markets and our economy today. Once again, guys, thank you for watching this video, and I will talk to you next time.